Good afternoon, everyone. My name is Lynn Giles, and first of all, I would like to express my gratitude to all of you for your support and your business. I wish all of you, your loved ones, and your clients continued health and patience during these unsettling times. Thank you to all my teammates at SSQ for stepping up, being here for us, remaining calm, adapting quickly to the changing times, and for truly putting our clients first. Today's presentation has been developed with recent investment in mind, as investors may be worried and seg funds may be a solution for people who've been exposed to these negative markets and who are looking for more security. Today, my goal is to provide you with some key talking points so you can easily explain to your clients how segregated funds behave and what is their value add. Have you ever felt like, what's next? Feels like we just got over 2008, the financial crisis. I remember saying back in 2008, geez, it feels like we just got through the tech bubble, and now this crisis. And here we are again. It's 12 years later, but to clients, it still feels like yesterday. Keep in mind, markets are cyclical. This is expected. This is a normal part of investing. We've experienced more volatility in 2020 than we did in all of 2017. Your clients do have money to invest. They may be nervous and scared of losing their money. With this uncertainty, markets react, and quite frankly, so do investors. They are emotional, and they make decisions based on their emotions and not on stats, statistics, and information. When there's uncertainty in the market, people are looking to you for your support and guidance. Without further ado, here's the agenda I'm going to be talking about today. First, I'm going to speak about the operational adjustments we've made, the DNA of seg funds, guarantees, and the importance of staying invested, and then finally, our platform and SSQ portfolios. Before we get into the advantages of seg funds, I'd like to bring you up to date on what we've done in the way of processing and our changes. We've had to adapt our traditional way of processing documents, and we're doing that to make it easier for you and for your clients to do business with us. We launched a microsite today, and you're going to be able to read all of the changes and updates, and they're going to be there updated all the way along, and it's going to be at your fingertips to keep you informed. Just go to ssq.ca, and the microsite will be there for you. I know, we're salespeople. We really don't like talking about paperwork, do we? Well, the good thing is we have a great solution. SSQ, we have launched an electronic application, which is completely paperless, web-based, and it's compatible with Android, Apple, Windows, so your clients can go onto an iPad, their iPhone, their Android or a laptop, and they can complete the application with you, non-face-to-face, and the best part is there's no wet signature required. You don't even need to print off a document. Nothing is printed. The clients don't print anything. Everything is electronic now when you're using the electronic application. And now you can add on a whole life. So now you can choose critical illness, term with the CI rider, and you can also do a whole life on the electronic application. If you need help, there's a webinar on our website. If you go to ssq.ca, as you can see, we have little snippet videos to help you every step of the way. If you do need help, you can reach out to any of your teammates across Canada at SSQ, either the director or their inside. We also have a 1-800 number for you to contact if you need help navigating through this application. But know that on the website, the tutorials are there for you. There's even a webinar that walks you through that one of my colleagues did last week. If you would like to write this number down, if you need help navigating, like I mentioned, and you can call 1-888-429-2543, and for English-speaking advisors, choose 9, and then 1 for insurance and 5 for electronic applications. Now that we have the administration out of the way, let's focus on you and your clients. Like I mentioned earlier, today my goal is to provide you with some key talking points for your clients. Some may be worried about the current situation, and while mutual funds obviously have a place in their portfolio, this might be the time to add segregated funds to offer some security through these difficult times. So let's explore the differences and the advantages of segregated funds. A lot of people wonder, what is the difference between a mutual fund and a segregated fund? It's summed up quite easily. There's growth potential for both. The difference is segregated funds offer capital preservation. While there is a magnitude of differences, there is one main similarity, and they both have growth potential. The difference is having the next slide is going to show you the advantages of choosing a segregated fund and what the advantages would be. So as you know, mutual funds have no guarantee whatsoever, but do you think clients know this? In my experience, clients assume that if they purchased a mutual fund at a bank, they have this expectation there's some form of a guarantee. They sometimes feel there's a guarantee either through the bank, or they feel that there's a coverage through CDIC, which is the Canadian Deposit Insurance Investment Corporation. That does not cover mutual funds, just so you're aware. And I think that clients, you may know that, and I may know that, but the clients may not know that. So it's important to talk about what the guarantees are and what they're really looking for, and really ask some good questions, what the clients expect and what they want. So Assurus, so if you look at the bottom number 7, I'd like to talk about Assurus for a second. All insurers in Canada belong to Assurus. We all belong, SSQ and all the insurers belong to Assurus, and that guarantees the insolvency of all the insurance companies in Canada. So specifically with segregated funds, Assurus guarantees 85% of the guaranteed amount. So not only do your clients, when they invest in a segregated fund in Canada with the insurers, they have guarantees, they have resets, potential for resets in some of the contracts. There's the potential to lock in growth in some of the contracts. Also, when there's a preferred beneficiary named or an irrevocable beneficiary named, they are exempt from seizure from creditors, and that's on the seg fund side. There's also the confidentiality factor. When a will is probated and it's in a mutual fund and the non-registered side, it can go to probate, or it will likely go to probate. And they will need to pay the EAT, the estate administration taxes on those funds. So when I see number 5, quick access to investments in the event of death, what that means is when a mutual fund goes through probate, it's going to take a lot longer to have the clearance certificate. That's why having the funds in a segregated fund with a beneficiary named, the funds are paid out upon death a lot faster, usually within 2 weeks. So when I look at those 7 features of a segregated fund, that helps you explain why there's a slightly higher MER to go into a segregated fund versus mutual funds. And remember, what is the guarantee on a mutual fund? The banks don't guarantee anything on a mutual fund, and there's no CDIC coverage on mutual funds. So the difference is all these seven advantages of segregated funds. But number 1, there are 2 guarantees for your clients with a seg fund versus a mutual fund. So keep those in mind. The next thing I'm going to talk about is the contract and understanding the contract. First of all, there's the investor, the annuitant, and the beneficiary. And we're going to explore each part of the contract. So number 1 thing to keep in mind is the non-registered assets for mutual funds and GICs. A client cannot name a beneficiary. However, I would bet that if you asked a client who is the beneficiary on your GIC or who is the beneficiary on their mutual fund, a lot of times because they've named a beneficiary on their RSP, they've assumed that they've also set up a beneficiary on their non-registered. Just keep in mind, they cannot name beneficiaries on mutual funds or on GICs if they're non-registered. So the advantage you have is when you sell a segregated fund is that you can name beneficiaries on all contracts and protect your clients, especially if it's a preferred beneficiary or an irrevocable beneficiary. That also adds the protection from creditors. So I'm going to walk through the investor first. The investor has control of the contract. The investor designates beneficiaries. They decide who is the annuitant. They decide they have all the rights to the contract, and they also can name contingent beneficiaries, contingent investors, successor annuitant, and they also make all the decisions on the investments and withdraw the funds. They also pay taxes on the contract. So if there's growth or if there's a capital loss or capital gain, the investor would be paying for or would claim the income tax on that. The annuitant. The annuitant has no control over the contract. That person is who the contract's life is based upon. So the investor can set up a successor annuitant at any point in time as well. So the contract ends when the annuitant passes away, unless there's a successor annuitant named. If there's a successor annuitant named, that person would continue the contract exactly as is. And then there's the beneficiary. The beneficiary, again, has no control over the contract. They receive the funds when the annuitant passes away, unless there's a successor annuitant. I'm having trouble with that word today. Having a preferred beneficiary or irrevocable beneficiary, that provides protection against creditors. Just keep in mind when you're setting up an irrevocable beneficiary, that person must sign off at any changes that the investor wants to make. So if the investor wants to withdraw money, they want to make switches or changes to anything in the contract, they need the signature of the irrevocable beneficiary. Very careful here, something very important to note. If a minor is an irrevocable beneficiary, that contract is blocked until that beneficiary reaches the age of majority. So they can't make any changes until they reach the age of majority, and then they can sign and they can start using the contract again, the investor. So just keep that in mind. Estate planning is a fantastic way to provide estate planning for your clients using a segregated fund contract. So say they may have most of their assets in mutual funds, which is, I'm not saying they're replacing mutual funds. I'm just saying that seg funds may have its place in your clients' portfolios and may provide some options for when someone passes away. If their funds are all tied up waiting for probate, or their property or their mutual funds, at least on the seg fund side, if they name a beneficiary, those people can receive the money and maybe pay the tax bill or the probate tax bill or maintain the property while it's being probated. At least they have something to keep them, buy groceries or pay bills while they're waiting for the probate. An advantage too to naming successor annuitants. So the big one is the taxes. So the advantage to the clients would be if it's a husband and wife, for an example, and the spouse, the surviving spouse, would just take over the contract exactly as is. So there's no deemed disposition, there's no tax implications. They just simply take over the contract as it is. So that's the nice thing, is that it defers taxes too on the second person's death. For you as the advisor, if you have sold the no load mode B and there's a clawback to you, that contract continues and there's no redemption. Also, if they're in a DSC, the clients wouldn't have to pay any fees. Their estate would save on any fees, so they would they can just continue the contract exactly as is, and then you would retain those assets. So let's talk about our guarantees next. We have 3 types of guarantees for our segregated funds. We have basic, we have enhanced, and we have optimal. Basic is a 75-75 and it matures at age 100. The enhanced is a 75-100 and that is either age 70 or 15 years, depending how the contract, what age the contract is opened. The optimal guarantee is 100-100. If the contract is opened before the age of 55, the maturity date is age 70. If the contract is opened after age 55, it's a 15-year guarantee. Let's explore each one by one. So our basic guarantee is a 75-75, and this can be open until the age of 90. The client profile, so the ideal client for this, really for any age, is, they're concerned about the MER, the lowest MER available on the platform. They're willing to, if they want to take advantage of having all of 40 funds available, they can choose global real estate, global infrastructure, international funds, and there's no restrictions whatsoever on the funds they can purchase. The 75-100, this can be open until the age of 75. Ideal client, I would say between 50 and 75. Clients who are looking for a little more security. They like knowing that there are resets available to them. They don't mind paying a little bit higher MER to have those resets and have the 100% death benefit. So the maturity can be reset twice a year all the way to age 85, 2 times per calendar year until age 85. The death benefit automatically resets every 3 years independent of the maturity guarantee. So the maturity guarantee is done between you and the client, and you decide when it's done. Maybe a good idea to do that is on the client's birthday, or if they receive a statement that's worth, when they see the investment is worth more than what they started with, they can call you and it's a manual reset, and that puts it out another 15 years. But the death benefit does not affect the maturity date at all, and it is automatically reset every 3 years as long as it's worth more than the last reset. And that's every 3 years. On the last reset on the death benefit is on the 80th birthday. Our piece de resistance, we're one of the few companies that still offer 100-100, and this can be opened until the day before the client turns 85. So I'd say ideally between ages 70 and 85, clients who are looking for the stability and the peace of mind knowing they have all the guarantees. For example, if someone did open this contract at age 50, they have 35 years of resets. So they could potentially reset their contract 70 times before the 85th birthday. And the death benefit could have been reset 10 times potentially if it was higher. So they can have, the death benefit would have reset from 50 to 85 to 80 on the death benefit, possibly 10 times, and 70 times the maturity. So that's a lot of reset potential to lock in those gains for clients. It's the same thing here, 2 resets till the 85th birthday per year, and the death benefit every 3 years on the anniversary date until the 80th birthday. Something makes it really unique with SSQ is that clients can add funds into this contract until age 100 and still have 100% death benefit. That's right, that's what I said. Someone at 95 can add money into that contract and still have 100% death benefit. So say, for example, your client opens a contract at 80 and they move to a retirement home and they sell their home or sell their property. They can add money to that contract. And you as the advisor, because you have a limited trading authority built into that contract, you don't even need a client's signature. As long as we have a void check on the file, the client or you can add funds into the contract and still have 100% death benefit without a client's signature. Or the client may have received an inheritance from their spouse or another family member, and those assets can be also added into the contract until age 100. So what happens on maturity? So on the 75, on the basic, the 75%, so on their 100th birthday, if it was $100,000, they would be guaranteed 75% or the higher of the market value. So if the market value was $120,000, they'd have $120,000. If their market value was $65,000, they would still, the beneficiaries or the person, if they lived to 100, they would get $75,000. On the enhanced and the optimal depends if there was resets. So it'd be on the reset amount, and it's going to be at the maturity value. So if they reset it after 25 years, whatever that guarantee would be becomes their new guarantee. Hopefully that was clear. Here's an example of the maturity guarantee. So for example, this client is 54 and they opened a contract for $200,000. And as you can see, there's normal market volatility. But if you notice at age 57, it was worth $225 approximately. So if there was a death benefit reset, it would possibly have been reset if they chose this on the 7,500 or the 100/100 guarantee. Their new death benefit could be reset there at 225. On the maturity, though, they could have possibly done, if you notice between 54 and 57, they could have done 2 resets a calendar year as that market was going up. Now, as it went down, they still have the maturity guarantee. So in this example, if they're 54, if they had chosen the optimal, which is the 100/100, they could have had a lot more. So if you look at age 69 there, and if they had done the reset through that time, they would be very happy at that point in time when they see that market volatility down to below 150. They would have been happy they did the reset at 225 at age 57. If you notice here, this is on the death benefit guarantee. So this example is a 65-year-old investor, and they invested $200,000. And this example is about the markets going down all the way along. The next slide, I'm going to show you what if the market went up all the way along. So I'm going to show you both options. So the enhanced and optimal, I mentioned before, the optimal is the 100/100 and the enhanced is the 75/100. So this example, the client's 65, they invested $200,000, and unfortunately the market went down for all those years. If you notice, I've indicated where the arrow at age 79. If they passed away at age 79, if that was in a mutual fund, their beneficiaries would have received $100,000, and if it was in a non-registered portfolio, they potentially could have had to pay probate or EAT fees, legal fees. Who knows how long that could have been tied up? Right now, with everything being, not the social distancing and a lot of offices closed, it's, I'm guessing, taking a lot longer than 3 or 4 months to start looking at probate or looking at probated wills. So they may not have their money for a long, long time. And plus, who knows what happens in that market volatility the way it is. If they did pass away, they would have invested $200,000 and their beneficiaries would have received $100,000. If it was in a segregated fund, if it was in a 7,500 or a 100/100, they would have received the $200,000. So just think of how the difference of the conversation would be if you were the client or if you were the advisor sitting across from the beneficiaries, and you can say to them, well, I know the mark is down to $100,000, but I protected you, your loved ones, or your mom or your dad or whoever it is. I protected you with 100% death benefit. So you're actually getting a check for $200,000, and you'll ever have that, within 2 or 3 weeks, compared to having to go through probate and have it be public information and pay any legal fees and accounting fees. These things are all considered. I just think this way, you've earned the trust. They now trust you. They look at the value of paying those seg fund fees, the difference of the guarantee fees. Here's, like I said, the next example where it shows if they chosen the 100/100 or the 7,500, if they start with $200,000 and if it gradually went up over the time, the death benefit, like I mentioned earlier, is reset every 3 years automatically on the anniversary of the contract. So in this case, if the client was 50 years old and started investing $200,000, every 3 years, the death benefit in this case would be resetting. If you look at age 80, and at age 83, every 3 years until the 80th birthday, they'd have a potential for reset on the death benefit. So no matter what the market does, they've reset their death benefit. So in this case, if they start with $200,000 at age 50, at age 65, if they passed away, their estate would have gotten, say, almost $475,000 because they did the resets on the death benefit, and it's automatically done. So I think not only did the beneficiaries receive the higher value, but they have also, the estate didn't have to pay the EAT, the estate administration tax. The investor was able to name beneficiaries. There could also be a successor annuitant. They also had the creditor protection if there's a preferred beneficiary named or an irrevocable. And number one thing that I think that is so important to people these days is privacy. It's not made public when it's an insurance contract as long as a beneficiary is named. So you're giving your clients privacy as well. So let's look at the importance of keeping your clients invested. Um, talking clients through their emotions, and remember the old adage, the catchphrase, buy low and sell high. Every economics course has taught us that. We know that, and fundamentally we get it. But clients are emotional. We're emotional. We still we think the bottom's falling out, and sometimes we panic and get nervous too. So I'm here to help you understand and hold your clients' hands, and well, not literally holding them right now with social distancing, but I think you get what I mean. Showing your clients index charts and tools and helping them stay invested. And hopefully the next few slides, I'm going to help you through that. So market volatility, all stock markets do go through intense periods of intense volatility. It is expected, or it should be expected. Regardless of the cause of the volatility, whether it's a financial crisis, whether it's a real estate crisis, whether it's a tech bubble, whether it's a pandemic, it's here to stay. Just keep in mind that markets always rebound. They always have, and they find their way back to normalcy within a few months, and the economy stabilizes. We have to remember that and look at the history. History does repeat itself. Hence the importance of staying invested and not panicking, and helping your clients stay invested and not panicking. Because as soon as they sell their asset and when it's down, they're locking in themselves at a loss. In the next few slides, I'm going to show you the importance of staying invested and what happens when you do sell, and if you choose to go to a GIC, and just show you the comparison between staying invested and panic selling and going into a secure investment. Here's an index chart, and I find this a very useful tool. As you can see, there's all the many crises over the years that happens. You see the market go down, and then you see the recovery, and then you see the market go down, and then you see the recovery. It's important to know that you have these tools available to you, and this is a great piece to show clients to help them see this is a normal part of investing. If you need a copy of this, you can go to Morningstar. You can ask one of us for it across Canada, our team, and we can get a copy for you. This kind of feels like deja vu from 2008, I feel. Like I said before, it just feels like it just happened and we just got past it. But, it's been 12 years. So the next few slides, I'm going to show you one of our funds. It's called the Balanced Strategy Portfolio. And I'm going to show you, again, what happened back in 2008 and 2009, and then where we've come from there. So this is an example of a client who purchased $10,000 on June 8th, 2008. And if you remember back then, what happened over the next 9 months after that was a tremendously volatile period in time. And so this client invested $10,000 on June the 30th, 2008. And then here we jump to February 28th, 2009. So that investment of $10,000 dropped down to $7,874, a whopping 21.26% drop. Some clients and advisors panicked, sold their clients' assets, and they put them into a GIC. And the GIC at the time, say, was 3%. So basically, they locked the client, or the client locked themselves in at a loss. In the next few slides, I'm going to show you what happens, or what happened. So that 78.74, they decided to put the money into a GIC. They couldn't handle the volatility and the fluctuations. So it would have taken them 8 years to recoup that loss. So if they invested the 78.74 at 3% into a GIA, over 8 years later, they would have recouped their losses. So they would have been back up to $10,000 in a GIA. What happens if they had just stayed invested in that same fund, the Balanced Strategy Fund? So they're $10,000 from June 30th, 2008 to the 9 years later on February 28th, 2017. That same $10,000 investment that dropped down to 78 was now back up and more, up 32%. So it would have been worth $13,213. So the same 8 years, same period, if they had chosen to stay invested, not panic, and listen to the financial advisor's advice to stay invested and not panic and stay the course. It's important here to talk to the clients about their investor profile. So ask the clients, what are their goals for the money? How long do they actually, will they be needing the money? If they're not looking to use the money today, they may only take a portion of it out. They only may need $2,000. So they might need it for retirement, which could be 20 or 30 years down the road. So they don't really need all the money today. So ask the questions, what are their goals? And if they can tolerate these fluctuations before they actually go into the market. And that's the best advice. So I'm going to talk about the SSQ investment platform for a moment. So I mentioned earlier we have over 40 funds to choose from on our platform. And that includes we have hedge funds, international funds, global real estate funds, global infrastructure funds, we have income funds, bond funds, and we have 3 portfolio families to choose from with automatic rebalancing. So we have all options for your clients, whether you're competing against some IIROC brokers, you can do that as well with our private wealth. You can reduce the MER substantially down, and the clients will have a reduced MER, and you'll have some great advice to offer your clients and compete nicely against some of your competitors. We also have the no load mode B, which is available to clients, not the private wealth. I'm talking about here, just the normal platform, is no load to the client, and you receive 3% upfront, no trailer for 2 years, and on the 25th month, you receive a full 1% trailer. Even on income funds or bond funds, you receive that 1% trailer. Now, we obviously have DSC and no load mode A and B, and we have front end. So we have all the options for you on the compensation side. The nice thing with our no load mode B, it's only a 2-year commitment to you, and the clawback would be prorated monthly. So if the client does a redemption, your clawback prorated monthly only on the redemption amount. On our platform, all of our managers that are on our platform, they're all independent and they're world-class managers who are managing billions of dollars on the pension side. So your clients have access to some of these managers and their funds for as low as a $400 lump sum contribution or a $40 pre-authorized payment. You notice the bottom of the slide here, GIAs and high yield accounts, they both can be open until age 99. So if you have clients who are older, they don't want to go in the market, or they can't open contracts with contract with seg funds over the age of 90, at least you have options up to age 99 to buy a high yield account or a GIA. And remember those 7 advantages of seg funds. You have the option on these 2 accounts to name beneficiaries, avoid the will and probate and privacy and all those great things. This is our Astronaut platform. So Astronaut is where you go as the advisor. Once you're contracted with SSQ, you should have received a username and password for our site. If you're not yet contracted, contact your MGA and they can set that up for you and get your contract set into us. On the website, you have the, here's where you enter your username and password, and then you log in. Once you're in, you can write to us. So when you click on write to us, that is how you can access our investment team. And you can, once the investment contract is actually set up for your clients, you as the advisor can place purchases, redemptions, switches without a client's signature. So it's very easy to do business with us. You can even, if you sell DSC, you can even send an email to us and say, please transfer all 10% free units available in all of my clients, and we'll do that for you right from this section right here. As well, you can also send attachments. So if there's a client, if you want to set up a contract for a new contract for a client, you can, the client can sign the documents and you can scan them to us, and you can scan them right here under write to us and send the email with the attachments. We're doing whatever it can to make it very easy for you to do business with SSQ and simple for your clients. Now, if you look here, you can click on all of our forms, any documentation, marketing pieces for clients, our GIA rates, the fund facts, the returns, everything is here at your fingertips. And on the right-hand side where it says client folder, this is where you can search all your clients. So you can look up all the clients you have with us just by clicking on search. If you want to search a client at a time, put in their last name or their contract number, and everything will come up as well. And you can look at the client's current values, any history, the transactions, the guarantees, everything is right here at your fingertips. And also for clients. Clients also can register on the website as the investor. They just need to have their account number and their birth date, and they can register for our site. The clients can pull up their statements, they can look at the history, they can look at their guarantees. They also can pull up their own tax slips. So the clients can pull up their own tax slips, and you can also pull up the client's tax slips for them. Another way we made it easy for clients, right, especially right now, is if you open a new contract, instead of sending a check in to us, we can just have a void check, and we can do a lump sum from a void check. Or the clients can go to their online banking through their bank and add SSQ as a bill payment on the menu. Our smart beta funds were added in 2019, and these it's a portfolio family of portfolios. And depending on the client's risk tolerance, if they're conservative, balanced growth, or aggressive growth, they can choose a portfolio, or you can choose a portfolio for them. Or you can choose, one of the three portfolios. You can choose either Celestia or Strategy or the Smart Beta, or a combination of. Or you can choose some. You want to have some at the lower MER, then add funds onto that platform, from the platform onto the client's portfolio. You can do that as well. Or if you need some help choosing these funds, you can reach out to any of our team across Canada, and we're all happy to do that. So the Smart Beta funds specifically are designed to provide a combination of active management as well as passive portfolio managers. So it's almost like a hybrid of an ETF and an actively managed portfolio. So the nice thing is the clients have a slightly lower MER, they have maximum diversification and low volatility, and that's what people are looking for right now. So if you need help with that, we have the large pension managers who are managing the funds within this are Triasma, AlphaFix, TD, and Tobin, who are big pension managers, and they are managing that portfolio. And it's designed for low volatility, low cost, and diversification. I mentioned earlier that we have the three portfolios. So we have the strategy portfolios. They're our first portfolios that were introduced years ago. And then we added Celestia, and then we have the Smart Beta. So you can either choose some of those funds, either a Triasma Canadian Equity Fund, or you can choose US funds. You can choose income funds. You can choose, like I mentioned before, global real estate, global infrastructure, or you can choose portfolios, or you can do a combination, or you can choose, 33% of each one, or 34%, depending on how much you want to choose for each client. And the nice thing is when you do the investor profile, if the client is a balanced, well, you can choose a balanced strategy, balanced Celestia, and balanced Smart Beta, or you can choose balanced funds. You can choose CI funds, you can choose Guardian funds, and Lazard Global Infrastructure on here, or Morgan Stanley Global Real Estate, or you can choose the portfolios that have that in there, and they're rebalanced quarterly. So I guess my point here of this slide is you can really build a nice portfolio for your clients, and we're here to help you do that. We want to make it as easy as possible to do business with us and have really good returns and options and a very good, solid contract. I would like to thank all of you for listening today and learning more about SSQ. We're here to help you and your clients through these uncertain times. As you can see, I'm very proud of our team. They've really stepped up, and you have a great team available to you across Canada. So if we start with BC, Jeff and Steve and Paul cover you in BC. In the Prairies, Adeline and Paul and Dino supports both of them. I cover from Hamilton to Windsor to Collingwood to Niagara, and Sally is my inside. I cover all of the MGAs. We cover all the MGAs across that area. Sam and Sheldon cover from Burlington to Toronto and some of the MGAs. And then we're excited to have Sean Redford, who just started last year with us. Him and Gordon Chan cover from Burlington to Toronto as well, certain MGAs. And then Barry and Safina cover Ontario East and North. And then we're excited again to have Sharon. She's a great addition to our team. She is covering Kingston, Ottawa, and the Atlantic provinces along with Josiane. So this ends our conference call today and our webinar, and I do appreciate your time. If you need help, reach out to any of us across Canada, or you can go to the advisor site, which is public, is ssq.ca, and your clients can pull up information on there. You can look at the information, and I do encourage you to go to our microsite for the constant updates that we're putting out there during this uncertain time. Thank you again, and I wish you and your families very much good health, and all the best.